Hi, let's talk about discount points as a common mortgage feature. Mortgage features. Common mortgage features often are a part of a mortgage but are not required by law. Common mortgage features include down payment, loan to value ratio, interest, loan servicing, escrow or impound account, discount points, loan origination fee, takeout commitment, buy down, partial release clause with a blanket mortgage. Discount points are discussed here. See our other learning videos regarding other mortgage features. Discount points. A discount point is an upfront fee charged by lenders. Discount points increase the lender's yield. Yield is defined as the amount the lender is making on the loan. Yield is expressed as an annual percentage rate or APR. By expressing the cost of a loan or yield as an APR, borrowers are able to compare the cost of one loan fairly to the cost of another. One discount point will increase the lender's yield by approximately 1/8%. This is added to the percentage rate charged. One discount point will cost the borrower 1% of the cost of the loan. Borrowers benefit from buying discount points by reducing the amount of interest rate charged by the lender. Over the course of the entire loan, the borrower may save substantially through paying less interest. However, the amount that a purchase discount point lowers the interest rate is negotiated between the lender and the borrower. It is not a set amount. For example, a lender may offer the buyer a rate of 3.5% or 3.3% if one discount point is purchased. Lender summary. A discount point is an upfront fee charged to the buyer that increases the lender's yield. Yield is the amount the lender is making on the loan. Yield is expressed as an annual percentage rate, APR, and it's equal to 1/8% increase in yield. Borrower summary. A discount point benefits the borrower in that it lowers the interest rate the borrower pays. It costs the borrower 1% of the loan amount per discount point. The amount of interest that it lowers varies with the deal negotiated with the lender. Calculations. To calculate yield, for every point bought, add 1/8 to the APR. Take the denominator, the 8, and divide into the numerator, the 1, to turn it into a decimal of 0.125. Add this to the lender's original yield. To calculate the cost of discount points, use this formula. Multiply the number of points bought by 1%. Take the total percent and multiply by the loan amount. Lender's yield story problem. A lender charges 2 points on a loan of $450,000 for a quoted interest of 3.5%. What is the lender's yield? Lender's yield solution. Lender charges 2 points on a loan of $450,000 for a quoted rate of 3.5%. What is the lender's yield? First, to calculate a lender's yield when 2 discount points are charged on a loan, remember that each discount point is worth 1/8% to the lender. Therefore, the lender's yield is being increased by 1/8% twice, or 1/8 plus 1/8 equals 2/8%. Second, because the interest charged is expressed as a decimal rather than a fraction, 2/8 must be turned into a decimal in order to add it to the interest. You do that by dividing the numerator by the denominator. 2 divided by 8 equals 0.25. Third, add the increase as a decimal to the interest being charged. So 0.25 plus 3.5% equals 3.75% yield to the lender. A lender charges 2 points on a loan of $450,000 for a quoted interest of 3.5%. What is the cost to the borrower? Discount point cost to borrower solution. First, multiply the number of points bought by 1%. In this case, we have 2 points being bought, so times 1% equals 2%. Second, take the total percentage and multiply by the loan amount. So 2% times $450,000, the loan amount, equals a $9,000 cost to the borrower. Comparing loan cost. By understanding how discount points increase yield, borrowers can compare loans to make a well-informed decision about which loan makes the most sense for the borrower. For example, one lender may offer a borrower a loan at 4.3%. A second lender may offer a loan at 3.8%, but only if the borrower purchases 2 discount points. Now remember that each discount point is going to increase the lender's yield by 1/8%, and in this case that would be 2/8, and 2/8 turned into a decimal would actually be 2.25. So the lender's yield in this scenario would increase by 0.25. So we can add the 0.25 to the rate being charged, which is 3.8%. which is going to give us an actual APR comparison at 4.05%. So what we're saying there is that the lender advertising the 3.8% with the two discount points is actually showing a comparable APR of the 4.05 percentage. And that's the whole point of the add-on to the lender's yield, so to speak, is to be able to give you an actual number to compare loan to loan. So by doing the little transition, we now are looking at an APR for the second loan option where you buy the discount points at being 4.05%. Now 4.05% is less than the 4.3% being offered by the first lender. So the borrower would pay less interest over the course of the loan. But is it a better deal for the borrower? That does depend on several factors. One being whether the borrower has the funds to pay for the discount points up front. Remember, discount points are charged to the borrower at 1% of the purchase price. It may also depend on whether the borrower plans to hold the loan for the full term or whether they plan to pay off the loan early through either possibly reselling the property in a much shorter time frame. Again, real estate licensees are not to advise buyers about loan options. However, it is appropriate to encourage buyers to receive a thorough explanation of costs and options from lenders. Discount point versus discount rate. Keep in mind as you memorize information about discount points that this is a different term and concept than discount rates. Also keep in mind that interest rates are negotiated between borrower and lender and are not set or controlled by the government.